All right. Welcome to the inaugural episode of the Elevate Roundtable. We're recording this on Wednesday, April 15th, 2026, around noon, 1 o'clock Eastern Time. We invite you behind the curtain of the investment and financial planning world, a seat at our table where seasoned professionals tackle market strategy and wealth stewardship in real time. We're a team of highly credentialed advisors who suit up to play at the highest level every day, sharing insights rarely heard outside the walls of an investment firm. Whether you're a client, a business owner, or simply an investor seeking wisdom and perspective, we're glad you're here. Now let us dive in. Good morning slash good afternoon, fellas. How are we doing today?
Doing great. Doing great. A little rain in Colorado. It's a blessing.
Man, it's been like 80 and sunny here. I could not be happier. The weather has been fantastic. But I figured we would start this off with a little intro. To me, you guys need no intro, but since this is the inaugural episode of the Roundtable, I figured we'd do a little quick intro for each of us. I'll kick us off. My name is Tom Damon, not Damon, as it looks to be spelled, and sometimes I do pronounce it Damon because it is easier phonetically. I am currently the investment operations specialist at Elevate Capital. I've been here for 3 years now, guys.
Wow,
Insane
crazy.
how time is flying. I have recently started studying for CFA level one the last couple months, so I'm CFA level one candidate. And I'm a Swiss Army knife here, man. Investment operations is where I live, but also assisting Shane with some portfolio management and some research and analytics. And I think that's a good for Shane's intro.
Yeah, well, I'm Shane Fleury. I'm the Chief Investment Officer, and I wear lots of other hats too, but that's my primary focus every single day is looking through a list of all of our positions, figuring out whether we're buyers or sellers of every ticker on the list, and then I guess carrying out those instructions using the technology that we've got in order to do that across our book of business so that everybody gets the same prices regardless of whether you got 10 bucks with us or 10 million bucks with us. So um, Tom is instrumental in helping me get through that list every day, but we have a pretty stringent process, and there's not too much that gets by us. We may not pick the tops and the bottoms every time because nobody actually can, but there's not much that gets by without our notice, and we always have a good reason for what we do, and we try to stay away from resulting, which is trying to determine whether a decision was good or bad based solely on the outcome. I think that's what most people do, and that is not how a good investment process works. So we're pretty focused on the process and on the rules, and just executing them day after day after day, regardless of all the noise. So that's me.
And
And I'm in Florida. I'm in Florida, and it's always hot in Florida, but it's only 79 and sunny today, so that's pretty cool for us. Lovely.
Yeah, I should have mentioned that it's 80 and sunny here in New Jersey, as it has been a horrid winter here. I'm gonna send this over to Mr. Armstrong, though. How you doing?
I'm doing great, thank you. I'm recently back from spending some time hiding from what was supposed to be winter in Colorado. I was in northern part of Phoenix, and then a week in Japan to pick up my son from some overseas studies that he had this last semester. So I'm recovering from some jet lag. I'm hopeful that by the weekend I'll be on a normal sleeping schedule. But I am the I'm a co-founder of Elevate along with Shane, and my role here is to take good care of our clients and go find new business and to do planning largely. I tell people we do all phases, right? Holistic planning, offense, defense, and strategy. So Tom and Shane do most of the offense, which is growing assets, and um, I do defensive planning, which is gets into estate planning and guiding people there. Even though we don't draft documents and such, we understand how that stuff works. That involves insurance, things like life and disability insurance as well, and then a lot of planning using financial planning tools and helping people to assess like the best way to get from where they are to where they want to go.
Because if you know where you are and you know where you want to go, it's much easier to end up either at that place or maybe even at a better place. But most people don't really know. They haven't really assessed that. You know, we joke about it in our business. We say most people spend more time planning their summer vacation than they do and buying researching the next car they're going to buy rather than they do figuring out their financial life. So that's what I really enjoy, sitting down face to face with people and understanding their world, understanding what's important to them and what they want to accomplish, and then helping them get there. So I'm
How
happy to
many
be here with
letters
you
do you
guys.
have? How many letters do you have after your name now,
I don't
Ken?
know. Can It's on the Zoom, right? Can you guys see that? I think it's
I can't
22.
I can't count that high. I don't know.
22, I think, is and I don't know. I don't know if I'll add any more or not. There's some that I've thought about regarding related to tax that I might go pursue, but I'm sitting tight for the time being.
Yeah, another holder of many credentials, last but certainly not least, is Mr. Lottman.
Yeah, thanks for the intro. So, I work at Elevate here as a wealth management advisor and do a lot of the same stuff that Ken does. You know, I do have some letters there, and one of those is the CFA. So, Shane has that as well. And we understand that that is one heck of a burden to bear for a few years getting through and a lot of work. So, Tom, we're excited to see you stepping up to the plate. So, it'll be good, but thanks for leading this call, and I think this will be good.
Hey, Kyle. Yeah, I've heard that it may be depending upon which search engine you use, but either the CFA or the sommelier test are known as the hardest tests in the world. So kudos to you guys for getting through that and getting those letters after your name.
Yeah, well, that's enough talking about all the work that I have cut out for me, fellas. No, you don't have to remind me. We're gonna start our conversation here. I think pointing this in the direction of our CFA charter holders, just kind of want to go over the current macro landscape of everything that's going on, maybe some portfolio strategy. So, Shane, you want to kick that off?
Yeah, sure. I was sorry. I was actually not too surprised because every time Kyle and I get on one of these calls, something happens in the markets, and so as we were starting the call, again, it's like 1 o'clock here on the East Coast. Um, the market decided to finally put in its first red candle of the day after ripping basically right back to its almost exactly its all-time high. So the
Yep.
all-time high for the S&P 500 cash coming into today is exactly 7002.28. And we just put in a high for the day of 700.92. So or less than we got less than a point from putting in a new intraday all-time high on the S&P 500. And of course, I wrote in my most recent commentary that I did not think the market would go just straight back to an all-time high from where it was coming from. And of course, the market likes to prove me wrong. So it basically did that, even though it didn't technically get to a brand new all-time high. I think that's virtually that's higher than I expected it to go without some volatility. And I believe it or not, the Iranians or Iranians, I always say it wrong, um, and the Trump administration are apparently going to have another round of talks about the ceasefire, which is now a week old, with no deal in place, and it's scheduled to end next Wednesday on the 22nd, unless it gets extended. Um, but ultimately, I guess, I write this in the commentaries and I'll say it to anybody who wants to listen. I'm not a political analyst or a war correspondent or any of that type of stuff. So I don't have a whole lot of value to add on how the war will play out. But I am an expert in markets, and what the market is trying to tell you over the past week is that the market believes that there will be some type of deal in place that opens the Strait of Hormuz and probably stops all the missiles and bombs from being lobbed at each other in the region. So, um, the market is often more right than I like to admit. But sometimes everybody just gets caught offside. So there's at least a chance that this big rally off the lows is just a lot of people caught on the wrong side and having to cover their shorts. I think you can see some evidence of that, just in the trading and in kind of the headlines that are coming out about who's off sides. Um, so that's always possible, and maybe this is a technical double top. Kyle would be more equipped to know whether that matters or not than I am. But as it stands right now, we are very, very close to an all-time high, and we do not have a peace agreement with Iran. And there's a whole bunch of other things going on in the background, other than just the fact that oil is over $90 a barrel still. We've got private credit issues. We've got the SaaS apocalypse, and every 5 minutes a new AI tool comes out putting disintermediating somebody else's business. So there is a lot to navigate out there, and I don't think anybody can just go out and call the all clear and say, hey, it's time to be max bullish. Even though that might turn out to be the right call, I think the current situation calls for at least a little bit of caution and maybe a little bit of extra cash. So I think that kind of sets the table for where we're at in market speak for right now. But any what I miss? Anybody got something to add to that?
One thing that I would say, I've been messaging you on Slack lately, but I just finished up George Soros's book. I think it's The Financial Alchemist, and he's journaling his walk through the late 80s of here's his predictions and how he's positioning in the market. And I think 90% of the entries start with I was wrong. And if he's wrong, I'm not even going to try to, speculate on the geopolitical backdrop because I don't have near the resources or the money that he did. So he was a market warrior, to say the least. So that's what I'll say there. And looking at the chart, I think right now it does look like we're going to new all-time highs. How far it goes, who knows? But looking pretty bullish at the moment.
It's
Yeah, it is.
hard to fathom with
It
all the
it
news that's
is,
coming out of there.
and that's something that I've been thinking about. I mean, hypothetically, if a deal comes into place and we're at all-time highs, like where do we go from there?
Yeah, does it continue to go higher, or is it a
Right.
buy the rumor, sell the news event, right?
In the short term, I don't think anybody really knows. But I do know this. I know that if you go and run the numbers and look at, the 3 month, 6 month, 12-month returns after hitting a new all-time high, you would be much better served buying every new all-time high than selling every new all-time high over all those time frames. So, over a day or a week or a month, I don't really know. But on those three time frames, 3 months, 6 months, 12 months out, let's just pick on the 12 months out version, right? If you bought every single new all-time high in the market, your 12-month return would be substantially higher than if you just buy and hold the S&P 500 um, and look at your average 1 year return, right? So the buying at a new all-time high will get you a higher return than just buying and holding and looking at an annual return. So again, I don't know how to predict the future, but I can tell you that analyzing the data, it says when the market hits a new all-time high, market's more likely to be higher a year later than lower. So
I
I
would
think that's
agree.
something that you have to take into consideration, even though sometimes it doesn't feel good. It's particularly if you sold some stocks a little bit lower and now you're having to buy them back higher, whether it's an index or a stock, whatever. That's another thing that I think people tend to get very wrong is like just because you sold, let's say you sold the S&P 500 at 6,900 and now it's at 7,000 and you're like, oh, well, I don't want to buy it back because I want to buy it back at six lower than where I sold it. Well, you might be waiting a while and the market might
Right.
run to 7,700 without you while you're waiting for it to come back. And then every single day you get to wake up and look at the market and kick yourself and say, gosh, I should have bought back. So it's kind of like a sunk cost, right? Where people will include sunk costs in their analysis of the net present value of an investment. And the CFA class will teach you that sunk costs are not to be included. in that calculation. And so what's most important is like what's going to happen now? What's going to happen from right now forward over whatever your time frame is? And this whole waiting until the market drops to where you sold it before you buy back in thing is not the right way to do it. I mean, just mathematically speaking, it's absolutely not the correct way. Um, and it just goes back to the resulting I mentioned earlier, right? I mean, when you continuing with this example, if you sold the S&P 500 at 6,800 or 6,900, whatever, um, did you sell all of it? Like, did you totally exit the market and did you go 100% to cash? If so, that was probably a bad decision. I don't think you had any evidence that that was a good decision. So, shouldn't have done that. And if all you did was maybe take 5 or 10% or take some of your profits off the table because things were very uncertain and we were going to war and there was no telling how low the market could go. So you started to take some profits off the table. Well, that's a good decision. Even if you have to put that money back to work at a slightly higher price, the decision that you made was good, even though the outcome may not be um, what you expected. So I think that's a major issue that most investors face, and I think most investment professionals, for that matter, because most advisors aren't any different than most retail clients, right? Is they're subject to all the same biases and emotions as anyone else. And so the good advisors tend to control those well, stick to the rules, stick to the process, even when things are extremely uncertain and chaotic. Um, so anyway, yeah, but I'd say if we hit a new all-time high, more than likely a year later, market will be higher.
Well, that's a good point. I think some comfortability being uncomfortable is a good thing. So you just gave me some more confidence if that is the position that we wind up in. You mentioned taking profits, something that we've actually done recently on some of our more speculative names, but I figured this is a good opportunity to sort of go into our portfolio strategy, what we're looking at for our clients, how we're handling some of our quality names that we're starting to trim down, but want like refusing to sell a little bit because they're such high quality businesses. So I'm going to go back to Shane on this one and start our conversation about our portfolio strategy at Elevate.
Yeah, I'll try to keep it brief so other people can get a chance to chime in and maybe even push back on some of our design. But almost all of our model portfolios for our clients across the risk continuum, right? Whether they're very conservative or very aggressive, are heavily based on an internally hedged model that looks a lot like, the Bridgewater all-weather portfolio, the biggest hedge fund in the world, or you could even say that that was based on Harry Brown's permanent portfolio, which was established in I think the early 80s, but maybe as early as the late 70s when it may have first come out. And so when we build an internally hedged portfolio, it's a little bit different for aggressive investors than conservative investors or moderate investors, but it's mostly all the same components. The original permanent portfolio was really just four buckets or baskets, whatever you want to call them. I usually use bucket, and it was stocks, bonds, gold, and cash in equal parts, 25% each. And that was a very low volatility way to capture an adequate return in the market without taking too much risk. So that's kind of the middle of the road, right? And if you were more conservative, then what you would want to do is increase the cash and bonds, decrease the stocks and the gold. And more aggressive investors would obviously increase the cash bucket and decrease the cash and the bonds buckets. So that's kind of the basic framework for how we design portfolios. And so when you hear us talking about, quality stocks or speculations, those are all part of the stocks component. It's just that we kind of separate high quality stocks from the more aggressive speculations, and we combine those together for people who are aggressive, but we don't include kind of the speculative names for people who are more conservative but still need exposure to stocks. And rather than just buy the S&P 500 index, we figure buying the highest quality businesses in the world over long periods of time makes a lot more sense and leads to better volatility adjusted results. So we have some pretty intense screens that we do. Uh, we won't just buy any stock at any price, right? We want to buy high quality stocks that produce high returns on equity or on invested capital, but high returns. Um, they produce high cash flow, right? And they're trading at a fair price. So we're not looking for value stocks. We're not looking for things that are worth 100 trading at 50. We're looking for things that are worth 100 trading at 100. So we just want to pay a fair price and own really, really great businesses because the stock price tends to reflect the intrinsic value over long periods of time. They certainly disconnect for short periods of time, but in the long run, a stock's annualized return will probably very closely match its growth of earnings per share. So those are the kinds of things that we're looking for in the stocks bucket, and we do some other unique things on bonds. Same thing with gold and cash, but um, that's where we're at today. Quality's been a little under pressure for over a year. Last year was the worst year for quality, and I think since the 2000 times. I put a chart in one of the recent commentaries about that. But quality's just been out of favor, and garbage momentum stocks have been in favor. So we definitely have some exposure to those for our aggressive clients.
Yeah, so a point that I wanted to bring up and maybe go more in depth on, and I know Kyle and Ken can speak on this too because it's something that we've been looking at as a company for a long time, but our alternative to holding corporate bonds is owning property and casualty insurance stocks. So I think it's a good conversation to have as to why and why we choose the businesses that we choose to invest in, like W.R. Berkeley, the Holy Grail, as I like to call it. If one of you guys want to go into that.
Go ahead, Kyle.
Yeah, so I thought one thing. So when you own a bond, you have, you're the first in line claim on assets. You get paid a fixed rate and things are good. But if interest rates go up in the future, you can experience a loss. Insurance companies, they invest conservatively, right? They take in a premium, they invest that, and as long as, losses are less than projected, they're doing well. And if their returns are reasonably good, that also helps them do well. So if you own that stock, it's similar to a bond. It just doesn't have that fixed rate associated with it. So, interest rates go up in the future, you're not going to get your butt kicked. So, a little bit of an edge in that regard. But, Ken and Shane, you two were the first that really came up with this idea. So, Ken, maybe you got a little more to add to that one.
Well, one of the other benefits of like property casualty insurance stocks is that paying the premiums for most people, whether it's corporations or individuals, it's not optional. So you have a nice amount of inflation protection, right? I'll give you an example. So before COVID, let's say your house is worth $750,000 and you're insuring it, right? Homeowners insurance, and your premium is whatever it is. Well, after COVID, your house is worth $1.5 million. So guess what happened to the premium on your homeowners insurance? It doubled. You
Yep.
going to fight back and say, I'm not paying it? No, of course not. You're going to pay it.
And if you
So,
have a mortgage, you don't even have a choice. They're going to make
yeah,
you have
right.
insurance or you're
Right.
not going to have a house anymore.
Exactly right. So, you know, you have a nice amount of inflation protection in those kinds of stocks, in these insurance stocks, because people are going to pay the premiums. Very few people are going to say, nah, I'm not willing to pay that homeowner's insurance premium anymore. I'm just going to go naked. So that gives them an additional bump, especially in times where, we have an inflationary environment. And, I would expect that that's what we're going to see going forward. We could talk for a long time about inflation and why that is likely, but shoot, oil is an input to pretty much everything, and oil is up from what, 60 something dollars a barrel to was 100 and something dollars a barrel. Now it's back down to 90 or 95. But I don't think that even if the Strait of Hormuz opens, oil prices, we'll see what they do, but we're going to have shortages all over the place because all the ships that left the Persian Gulf before this conflict started, those are all the last of them are going to be arriving at their ports here very soon. And guess what? There aren't any more ships following them, not for a while. Even the ones that are starting to leave because of the U.S. kind of taking control of that and trying to get some oil moving again, those are going to take weeks to get to where they're going to go. So I think we're going to be in for inflation, and it's going to be awfully hard for any Fed chair, even if it's Kevin Warsh trying to do the bidding of Donald Trump to cut interest rates in the face of rising inflation.
Well, today so far, 6 ships have transited the strait in both
And
directions.
what's normal? Do you have any idea?
For the
Way
month
more
of
than 6.
for the month of February, the average was about 120, maybe
Yeah,
115.
yeah.
So yeah, 6. And not all, I don't have right in front of me how many of those were tankers versus, dry cargo. But that's the point is that it's still down 90% and it's been down that low. I mean, it was March 2nd was the first day that only 5 ships transited bidirectionally, right? Either east to west or west to east. And yeah, I mean, they say that the strait's open right now, but you see what's going on. I just don't, like I wrote in my commentary, right? Like, hey, let's go on a cruise. Why don't you bring your family? We're gonna go to the Strait of Hormuz. I don't see a lot of people signing up for that trip. I don't see it. Not to mention, you're gonna have to have gas. You're gonna have to have fuel in that ship in order to do it, and you're gonna pay a lot of money for that fuel. Jet fuel's out of control. Fertilizer is another big one that's out of control. That is a major input in everything that people eat, right? So you have oil, you got fertilizer, and then you've got major inputs for semiconductors. So all
Helium.
that's going to put upward pressure on inflation, and it's not all going to show up at once. Yes, the gas price shows up quickly, the oil price shows up quickly, and maybe that'll fade a little bit. But I'm not predicting. I'm just saying I don't see oil going back to 65 or whatever it started at the beginning of this year. Even if the war is, everybody signs a ceasefire deal tomorrow and the straits open and everything goes back to normal, whatever that is. Oil was under 60 when the calendar turned to 2026. I think if oil gets back to 80, people will be happy, right? Today, as we're speaking, it's 91.7 for West Texas Intermediate crude, which, is great compared to 120, but it's also still 60% higher than where it was at the beginning of the year. So, yeah, gas prices probably aren't going straight back to where they were. Even somebody in the Trump administration the other day said they expect gas prices to stay high through November. November is a long way from now. It's April 15th. So we got a ways to go. I think there's going to be plenty more inflation, which means the Fed's going to be a lot less likely to cut interest rates. Maybe even have to hike them, right? Which is going to disproportionately hurt the people who are spending more of their take-home pay on oil, on gas for their car. So it's just another one of those cases of the K-shaped economy where the wealthy do, okay. They do okay compared to the poorest in our country. And I'll tell you what, I've said it before, I'll say it probably many times in the future, but nothing frightens me more than people who have absolutely nothing to lose or think they have nothing to lose, right? That's when stuff starts getting real crazy. And, you know, internal conflict within this country. I mean, I don't think there's ever been a wider divide between a lot of people, and a lot of people look at it and think it's political, but I think it's more class based than a lot of people are willing to admit. Where, the poorest really, I think they have a good bone to pick with some of the wealthiest. Who take advantage of them. What were you talking about earlier, Kyle? The guy who's going to be the new Kevin Warsh, the new head of the Fed. What was he worth? What was his net
Oh
worth?
gosh, I forget the number, 200 and some odd million.
$200 million.
192.
Yeah.
192
Yeah.
is what he
Yes.
disclosed, but it's probably a whole lot more than that.
Yeah. So my comment was like, I have a hard time believing this guy's there to look out for the little guy, and
They never are.
I'm a little guy in this context, right? I got nowhere near $200 million. I'm not in that club. I am the little guy. Even though I'm blessed and I know I have plenty to lose. I'm not trying to um, play that down. We do fine, but I don't have $200 million. Promise. Maybe
Well,
someday.
speaking of inflation, this wasn't necessarily on our agenda, but I think it is a good opportunity to sort of go back and talk about some of the quality names that we're holding and how inflation could potentially affect those. Um, because like we talk about all the time, we have these holdings, Coca-Cola, McDonald's. We just recently took a position in waste management, and it's interesting to think about inflation to those businesses in particular because no matter what the inflation number is, I don't think anyone's going to stop buying Hershey bars or Coca-Cola or McDonald's or having to throw out their trash. So I think that's a good conversation to have because remember Shane was talking about being an underperformer over the past year or so, and maybe if there's an opportunity there.
Yeah, well, I'll tell you what, before we do that, I want to take one quick step back to the insurance market. And I know we don't have a ton of time here, but I think the one of the big things right now for insurance that I need to focus on and we as a team need to kind of, I think, have at least a game plan. It does seem that insurance is entering into a softer pricing cycle. So in insurance, you have hard pricing cycles and soft pricing cycles, and the difference is the ability to get an adequate premium, right? So in a hard market, um, more people are looking for insurance than are willing to provide it, and the insurers can raise the price and kind of command whatever price they want. In a soft market, people are rushing in to offer insurance, and many of the people rushing in are willing to accept a lower premium for the same insurance, all else equal. And those people who are lowballing and underpricing the insurance, those companies that are doing that, they're not going to figure it out that they've underpriced that insurance until claims start getting filed, usually 3, 4, 5, 6 years down the road. By then, it's way too late, and their underwriting profits will get absolutely annihilated. And these cycles come and go, right? We choose to own the best insurers in the world that have the lowest combined ratio, um, which I won't get into explaining what that is, but we own the best. We own the best of the best. And if they ever underwrite poorly, we'll sell them, right? If they have a poor combined ratio for 2 consecutive quarters, then we'll get out of it because we don't want to own a crappy insurer. So we own the best of the best. However, the problem with owning the best of the best is that they will not chase revenue. So when they encounter a soft pricing environment where, Tom Damon's family insurance comes in and starts offering me homeowners insurance for half of the price of Travelers, Travelers is going to be like, "See ya.
Right.
I'm not going to match Tommy Boy's price." Right? Your price is your price. If you want to have Travelers insurance, this is what you're going to pay me, and if not, then take a hike. Good luck with Tommy Boy, right? And so what happens when the greatest insurance companies in the world do that is their revenue falls. And maybe it doesn't fall. Maybe it just doesn't grow by as much because there's a lot of people who've been with Chubb for a lot of years, or Travelers for a lot of years, or W.R. Berkeley for a lot of years, and they're not going to change their insurance just to save a few bucks, right? They're good, they're happy, they've filed claims, whatever the case. And they're going to keep paying their premium even though it's going to go up with inflation. But some people are going to say, "Look, I need to save money. And this guy's offering me the same amount of insurance on my home for a lower price, and I'm going to switch." And that's going to cause the best insurers in the world to do less revenue than they would have in a hard market. So that translates to Wall Street, and the Wall Street analysts who are all short-term, short-sighted, look at one quarter to the next, is they're going to look at the next quarter's revenue growth, and they're going to say, "Oh no, Travelers' revenue didn't grow as much as it did in the quarter previous, or it fell, heaven forbid." And they're going to come out with a sell rating on Travelers because it's making a good business decision, right? It's making a good long-term business decision, is going to earn it a sell rating from Wall Street. And all the portfolio managers of the world that don't know how to do their own homework are going to go out and they're going to follow those ratings, and Travelers is going to get sold. even though its business is going to become intrinsically more and more and more valuable during that time. The price is going to disconnect from that. We're going to watch it happen on our screen, right? We're going to see the price fall from whatever it is now to wherever it's going. And meanwhile, we're looking at it saying, holy crap, we're getting a great deal from Mr. Market to buy more travelers. And I'm going to be wanting to buy more and more and more of it so long as the underwriting profits, are the combined ratio is good and they're not chasing that revenue. Um, so here's where the question comes in for me is, how many of our clients really want to ride that out? We've done it before. We've ridden travelers in WR Berkeley while they've been down 50%, and they always come roaring back because it's literally the best business on the planet, and we own the best of the best in that category. I'm perfectly comfortable with it. I have a ton of my own personal money invested in these stocks, all my long-term money, money for my nephews and my daughter and, foster children, everything. I'm totally cool with it, but it's ultra long-term money. How many of our clients are going to take that long-term perspective? And is there something we should be looking at doing about it? If we know we're entering a soft market, should we be reducing our insurance exposure in favor of something else? Unfortunately, that something else is probably bonds, right? Highly rated corporate bonds, intermediate term, maybe even longer term. Is that a better place to be if we're heading into a soft insurance market? And how much time do you think our clients will give us to ride out a soft market? Ken, Kyle, do you have any thoughts on
Well,
any of that?
I'm curious, Shane, because I honestly don't know the answer. What causes a soft or a hard market in the
Supply
insurance world?
and I think mostly supply and demand and lack of catastrophes. So over the past couple of years, we haven't had as many hurricanes. I don't think any hurricanes made landfall in the US last year. I could be wrong. You can AI check me on that later. But I don't think so. I don't remember preparing for any in Florida last year. A couple of years ago, there were some bad ones, caused a lot of flooding, a lot of damage.
Yeah.
I don't remember there being any major fires last year. I mean, I know there were fires. There's always fires, and for the people who are impacted by them, they're like super devastating. So I'm not saying there weren't any fires, but I think relative to recent history, there weren't as many as normal. There haven't been as many catastrophic losses recently. And so when that happens, some of these actuaries and the people who who come up with the price term for a policy, they get a little lax and they go out and they say they see that the hard market was happening and they're like, "Hey, these guys are charging this much for that policy." And based on our modeling, we could like let's go chase down that business. Let's go take money from these companies who are charging too much, offer our insurance policy for a little bit less. People are already getting killed by inflation. Everybody knows how much auto insurance has gone up since COVID, basically, right? So I think it's supply and demand like anything else.
Mm.
When and of course, what led to the hard market was all those soft market guys getting whacked and finding out that they had mispriced their policies, right? So it's a cycle. It happens over and over and over and over again. The difference is this most recent hard market has been one of the longest in history. Um, and so I think there is room for them to push premiums down by new people coming in and underpricing policies. And it always takes years before they find out that they've underpriced the policy.
Mhm.
So, I mean, that's kind of, and I'm not an insurance executive. I'm an analyst who studies this stuff, right? So I'm not trying to write you a textbook on it, but that's essentially what leads to hard markets and soft markets, and that'll be with us until the end of time. So you'll
Mm.
always have that. And the question is like, because there's a soft market. This is me. I'm obviously biased and would prefer to just own these companies through thick and thin as long as they maintain their underwriting discipline. But like, do you want to try and time those shifts from hard to soft? And do we want to take the profits that we've earned on these insurance companies over the long run for people in taxable accounts, pay the taxes, and then look for an opportunity to buy it back when the hard market comes back around? I I don't know. I mean, seems like a lot of extra effort and risk for not very much upside because you could just hold it through it and know it's not like we're not watching them, right? We look at the quarterly earnings. We look at what this company is reporting. We read the transcripts or listen to the phone calls, and we know that executives are saying like, "Hey, we're not chasing this. We had the opportunity to write this many policies, but we didn't because we're not gonna price match." And so those are the kinds of companies I actually want to own. Wall Street, under its short-termism lens, is going to punish those companies for a short time, and I think that's our opportunity. So maybe we don't want to be overweight them,
Mhm.
going into a soft market, but I don't think it's a good reason to abandon them completely. Um, and I want to give you guys an opportunity to answer the question, but it's like, what's the alternative? What is our safe money holding if it's not that? What are our options?
Yeah, it would seem to me that the options are going to be bonds, but short term, like I, IGSB, right? Investment grade short term bond. What is it? Maturities of 5 years or less, because you're not going to have as much interest rate risk or short term treasuries,
But that's what
a
we got in
year
our
or
cash
less.
bucket. That's not in our bonds, but it's a bond, yes, but it's short
Yeah.
term enough that it's our cat. That's like the longest duration for our cash bucket. So what you're basically saying is you would reduce the insurance bucket and take up the cash bucket.
Yeah, I certainly wouldn't want to buy long term bonds. Yeah, but I would agree with you. I wouldn't abandon them altogether. Probably not overweight, maybe even underweight a little bit, but um, hold the majority of the position, but not certainly not overweight it, and have that cash available to purchase when it seems like things are improving, right? Um, Cheap hated it in the beginning of an uptrend. That's a whole different conversation. But Kyle, what are your thoughts?
I think it's a mix. So you go to the fixed income alternative, there's that portion. I think if you want any bit of that equity exposure, it's just something that we've kind of talked about is this you can have an equity sleeve or an equity holding within these portfolios we talk about. And maybe it's that mix of having a portion of that little bucket or sleeve being some equity. And that could be just even large cap standard if you're just looking at a risk state perspective. That's my initial take on that, but I honestly don't really know the answer to it. But that's how I might try and construct something that maybe has some of that cash flow and volatility that might mirror a bond holding or an insurance company.
And but that's a lot of what we actually have in our quality stocks, you know, sector or sleeve or whatever you want to call it, right? So I mean, again, going back to the original design of the internally hedged portfolio is that it's cash, it's bonds, it's stocks, and it's gold. And of course, we've modified that. Anybody who's read my commentaries, I think the January commentary might have been the most in-depth review of like how we've modified some of those things. So like, but the insurance stocks bucket is the bonds bucket of the permanent portfolio theory or the all-weather portfolio theory, right? Which again is like these are it's the biggest hedge fund in the world, right? So how am I going to improve upon what Ray Dalio has taught the world? I'm just going to copy it and do it with insane discipline. So for me, like that bucket kind of has to stay bond-like, right? So I guess maybe what Kyle's saying is that, and this is something I've thought plenty over the years, is like, would you rather own Coca-Cola or a bond? Like Coca-Cola is pretty darn close to what a bond is. Yeah, the price is going to move around a bit, but it's going to keep paying its dividend. Um, but nobody said this yet, so I'm gonna tee it up for either Kyle or Ken. But why don't we want to own bonds, like intermediate term bonds or even a long term bond? Like, what's wrong with right now for owning those bonds?
I know for me, the first thing that comes to mind when you own a longer term bond is that if we do have inflation and it starts to get away from us, the value of that bond's going to go down. That's the
Mhm.
trade-off is that they can't adjust the interest rate of the actual bond. The market adjusts the interest rate. So if that interest rate goes up in the market, then the price of that bond, you put $100 in, now it's worth $90. So
Yep.
Yeah,
That's
that
that's
that's
that's kind of
exactly
what I
it.
was getting at. And that's part of the reason that we love insurance instead of bonds, even even in a market where interest rates aren't rising. But in the case of an interest rate rise or an inflation rise, like particularly with inflation, that's that is wind in the sails for an insurance company. It causes their premium to go up, right? Higher inflation is really, really bad for a bond. It's going to cause the interest rate to go up, which means the price has to go down, right? Because those are
Mhm.
inversely related. So that's part of the reason that, I'm just like, well, what are we going to own? Because really, it's like I hadn't given the idea of just like, dividend forever type stocks as an alternative for the bond. I hadn't really given that thought because that's mostly what we own in the quality stocks bucket
Mhm.
anyway. So really it's more just like it'd just be more of what we've already done with the quality portion of the portfolio, which maybe makes some sense. I mean, you could also just do something like like the minimum volatility ETF, right? The S&P 500 I can't remember what the ticker on that thing is, but we've owned it before. It does okay. It's just low volatility, high quality stocks that pay dividends for the most part. So that might be something to consider as an alternative as well. Um, but anyway, it's just something I've been thinking about lately. And I know we're probably running short on time, but I wanted to get back to that discussion and get your guys' thoughts on that before we moved on to whatever the question was that Tom asked me about quality stocks.
Yes, well, we are running low on time, so maybe we can get to my question on the next episode of the roundtable.
Do we know when we're going to do the next episode of the roundtable? Do we have like a date?
1 month,
1 month from now? Is it
one
going to be
month
like
from
on the
now.
15th of the month or on like the third Wednesday of the month? Do we have any?
It is on Thursday, the 21st.
Thursday the 21st is the next recording. All right.
Get your uh get your research ready on quality stocks, because
I'm
we're
going
going
to
to be
get taken to task.
we are going to be talking about Coca-Cola and Hershey, McDonald's, waste management. Um,
Hopefully we
but
can talk about some sexy momentum names too.
yes, yes, we have a market technician here. So
Chief.
he'll go into that
Chief.
for sure. And it would not be an Elevate podcast if we didn't go at least a half an hour talking about property and casualty insurance. So but honestly, I'm really glad that we got into it because I mean, for me, it's really like our bread and butter, high conviction stuff. Some like Shane said, the best businesses in the world, something that we own a lot of. So I'm glad that we went into detail on that. I think this is a good opportunity to sort of just give our closing thoughts. I know we kind of wanted to go around, give one thing that we're sort of watching, some developments that we're watching, any notes that we had. For me, I can't stop looking at these SaaS names, man. Like the Adobes, the Intuits, even Microsoft's just getting body slammed. And it's really hard to tell whether them getting body slammed like this is largely from the risk of AI, but I think Shane and I are kind of calling BS, especially on some of these great names that have been great businesses for my entire life. I've turned 30, by the way. So when I said in the intro we were seasoned professionals, I officially fit that category. But like I said, ServiceNow is another one that Shane and I have on our radar. Just like pretty mind-boggled that they're getting slammed as hard as they're getting slammed. So that's one thing for me. I'll throw this to Kyle. Anything you got?
I think right now it's mostly on the macro front. So I'm looking at the S&P, seeing are we going to new all-time highs? And the big one is sector rotation. It looked like we were moving out of the, top 10. So Microsoft, Tesla, the large caps that have really led, Nvidia is one for sure. And now those are bouncing, which that's a positive, of course. But, I'm just curious, is there more money that's going to shift into the mid cap value type plays? And that's a good thing, but just kind of watching to see if that's really going to be happening under the surface.
Yeah, that's a good point. I was looking at our SMLF, one of the small cap ETFs that we own, I think made a high today, which is really interesting. Ken, any your thoughts? Any closing thoughts here?
Uh, you know, I think that there's still opportunity in energy names. I don't think that I don't think the mess in the Middle East is going to resolve itself in a way that all these, like oil is going to come back down to where it was and all those kinds of things. So I think there's opportunity there, but I'm glad that I don't make all those decisions for the firm, and you and Shane get to make most of those. I know we have conversations about these things, but that's not my particular expertise. But from what I've been reading, this is not it's more structural. Oil's going to remain high. There's going to be opportunities for some of these companies like Venture Global, for example, who help with produce facilities for exporting LNG. I I think there's still plenty of opportunity in those kinds of stocks.
Yeah, and I'm with you on not being the guy who makes the decisions. I help make the decisions, but I don't make the decisions. Um, Celsius was one of my names, and I was joking with Shane before. It was looking so good until it wasn't.
Oh
So
man.
that's why I don't make the decisions yet around here.
I know it tastes good though.
So biased. I am so biased. Shane, any closing thoughts? What are you looking at?
I've talked enough, but I will say just briefly, like, yeah, the top 10 biggest stocks they have our attention. They've had our attention all year as underperformers, but I mean, Nvidia's up 20% off its lows, Amazon's up 25% off its lows. Broadcom is up 35% off its lows. Thankfully, we recently made Broadcom our largest holding in the top 10. Actually, it and Amazon are our top largest holdings within the top 10 basket. And those are both, up a lot over the past week, basically. And that's a lot of movement for a big company in that short of a time period. And we've also been watching like ExxonMobil and Venture Global, which, Exxon's down 15% off its high. Venture Global's down like 30% off its high. And those might represent some attractive entry points. We do have a little bit of cash to put to work, both in the quality area of our book and in the speculations area. So we're looking to get that cash allocated. And I tend to agree that higher for longer is probably more likely than not in the oil and gas markets. So I like the kind of 6 to 18 month um, return profile potential for those energy companies. Um, so we'll see. Maybe we'll have something to report back on as far as changes next time we talk.
Very nice. Thank you, gentlemen. And thank you all who are listening for joining us at the Elevate Roundtable. If you're a current client and want to discuss how any of today's topics apply to your specific situation, please reach out to our team. If you're a prospective client and today's conversation resonated with you, we'd love to connect. Until next time, keep elevating.
Later.
See
Later.
you guys.